Okay, so should we start our discussion? So I'm gonna introduce myself. I'm Bella Park. I'm working as a client partner in Caladan. Yeah, my friends are there. Caladan people are there. It's been honored to joining this panel. And today, actually, my purpose of hosting this panel, like we're already working across with a lot of like RWA projects, but I actually want to understand better about can I use RWA blockchain and can I convince my friends and maybe like families to actually invest on this kind of concept? So I want to cover some possibly like elementary level questions also. So yeah, happy to introduce you guys. So could you please introduce yourself?
Yeah, so my name is John, JPM, founder CEO of Mantra, which is a real world asset layer one, launching mainnet next month.
Hi, everyone. Name's Ian. I'm the Chief Strategy Officer at Ondo. Ondo is the leading RWA tokenization provider with give or take 600 million in AUM.
My name's Joe Flanagan, co-founder of Maple Finance. Maple is the leading institutional lending platform, and so we facilitate lending to the largest crypto institutions.
Hey guys, my name is Teddy. I'm co-founder and CBO of Plume. We're in a EVM permissionless network focused purely on RWAs.
Yeah, thanks for the intro. So my first question begins with like interoperability issue. So when it comes to defining interoperability issue, like it's difficult to transfer data or assets between different blockchains. And what you guys are actually solving and building is actually bringing the real world asset to the blockchain. So can you explain how you guys are solving this kind of issue based on what you guys are building and what you guys are focusing? Let's start with Mantra.
Okay. So I think when it comes to RWAs, you need to have a ledger of provenance for where they originate from, right? So we believe that in time there will be, proliferation of these assets across different chains, Mantra, Plume, Solana, Aptos, etc. I actually think that for most projects, it doesn't really matter which chain you're on. It's really about like where do you find, the ability to actually trust who you're being issued with. People ask me a lot like why do you have assets on Mantra and not Solana or not Aptos or whatever? Honestly, because like the people who are issuing these things can legitimately just call me and be like, hey, what's going on if something fucks up, which is incredibly important, I think, when it comes to real world assets, which is all predicated on trust and understanding where the connection to the real world is, right? So we're trying to build, I think all of us are trying to build a world where you can not have to worry about that level of trust, at least from the point of origination. And then you can, use these across different blockchains, across different virtual machines, different ecosystems, but that's going to take a pretty significant amount of time. That being said, the ability to actually redeem for the underlying thing has to always come back, at least for the time being, to the origination point where it has provenance from, right? So like if you take a asset originated on Mantra and then we're a CosmWasm IBC compatible chain. So if you move it across into Injective or DYDX or something like that, and then would try to go to, let's say it's a tokenized house as an example, and try to go back to the originator and it's on Injective, they would probably be like, what the hell is this? I don't recognize it. But if they would bring that back, then they could actually redeem it back for the underlying thing. So that doesn't mean that the value can't pass through, but there is always going to be a single point of origination. And, that's kind of what we're trying to build for, I think.
Can we also listen from like Teddy's? Because like Plume is building modular blockchain. So can you explain like what's the difference between what Mantra is building and how you guys are solving? Adding to my questions.
Yeah. I mean, I think JPM touched upon it a bit. But like from our perspective, the way we see interoperability is really, basically connectivity with the rest of the crypto ecosystem. I think, there's a lot of different chains out there and there's a lot of liquidity that's fragmented upon these different chains. And in order to really, foster a true RWA network, you need to have connectivity with like the main source of liquidity. So for us, we thought that becoming an EVM chain made the most sense because a lot of liquidity does originate on ETH, and it's very easy to go from ETH to an EVM chain like us. And in addition to that, we have a lot of the tooling in place for a lot of these projects. So we catch a lot of our projects upstream, I would say. We have created our own no-code tokenization engine that really handles all the legal and admin functionality for when these projects are looking to deploy in their early stages. And then for the more developed projects, we also have very, I would say, developed ecosystem incentives to really help create a brand for these projects and help them go to market. So a lot of the projects that we work with, and we're working with over 160 projects now on our testnet and our mainnet's launching later this quarter. We're tokenizing a little bit over $1.5 billion of assets through our engine, which we'll be announcing later this quarter as well. But for us, I think the main value add is that we're seen as a distribution platform on the go-to-market side and also on the demand side for these projects. Since we do have a capital markets BD team helping source liquidity from different on-chain and off-chain sources, and I think as a combined package, we're really seen as a fully integrated chain for the different projects that we work with.
Thank you.
Yeah, I want to build on something you said, which I think is very true, is that ultimately what a company should care about is distribution, right? Like, how do you get a real world asset into the hand of the end investor in a place where they want to use it? That is ultimately pretty key. And so at Ondo, I think we're now live on 10, 11 different chains, give or take. Like, it's a lot of them, EVMs and non-EVMs. And I can tell you, to do that, it's a nightmare. It's a complete nightmare. And so when we think about what's next for RWAs and how to scale the RWA space back to the original question of how big of a problem is omni-chain and interoperability, I think it's huge. Because now you're getting the likes of a BlackRock that start to move on chain with Bode, and they go on to Ethereum. But if they really want to go where the capital is, next step, maybe they go to Solana, maybe they go to the broader EVM ecosystem. At some point, maybe they'll go to Aptos. Maybe they want to also go to Sui, Cosmos. That's just not a reasonable expectation to have of a very big asset manager. They're just not going to be able to do that and figure that out. Neither should they, right? And so I think when we think about next gen infrastructure, what's really needed, I think that interoperability is absolutely key, because otherwise we're going to struggle to get adoption and get more RWAs into the crypto ecosystem, because it's just not reasonable to expect of the big TradFis that they're going to have to figure that out.
Yeah, and to build on that, like one of the bigger things for us is that, and where we differ from some of these guys about tokenizing real world assets, is that we actually issue the assets ourselves. So we are originating private credit loans directly on chain. And so you get the immediate issuance of your real world asset. And that really separates us, because we don't have this friction of how we bringing something that exists in the real world and bringing it into an on-chain context. But the same fractionalization of liquidity issues remain for us. Anytime that we go to another chain or to another liquidity source, we then have to go and arrange the subsequent loans for that capital. And so you start to have real issues from an operational perspective for us, where we've raised capital here, here, and here, and then we have subsequent loan books that we have to manage. And so for us, we've really concentrated ourselves on Ethereum. And we will look at other bridging solutions to bring capital in from all of these different locations, but to have it landing in one centralized place. Because managing that liquidity for us across multiple loan books is very difficult and time consuming.
Thank you. I also agree that distribution is the key to when it comes to understand in consumers' perspective. I also agree with that. And my next question would be, how could this RWA could be like calculated, and how do you like price those kind of real world assets to the blockchain?
Again, the big benefit for us is that everything gets priced on chain. And so I think like this is ultimately where RWAs have to get to, and it's going to take a long time, but where we can get away from it just being what are the legal frameworks and workarounds that we're getting to bring something that exists in the real world into an on-chain context. How can we get actual issuance to exist on-chain? And so that's what we've done at Maple from the very beginning. Like we've originated close to $5 billion in loans through our platform end to end. And so we get the real benefit of aggregation of capital, loan settlement, loan servicing, all happens end to end through our smart contracts. And so what that results in is that you get all of that transparency. So all of the pricing exists, all of the collateral exists. And so that ultimately is where all real world assets have to get to. We just get the benefit because we built a platform that shoots private credit. It's the easiest way to do it. for assets that exist in the real world. This is a real a pain point to try and bring a legal framework to bring it into a tokenized form.
I think it really is an asset class by asset class consideration, and it's definitely a problem. A lot of these things are not priced like constantly, particularly if you're talking like real estate, like it's not fluctuating on a daily basis. It like really shouldn't be. I mean, that would be a problem. But a lot of the premise of real world asset tokenization is this idea of having some degree of a liquid secondary market, even if this asset itself is generally not a liquid thing. And that's a hard thing. So like obviously working with different Oracle providers is something that you'll have to transmute real world pricing back to a blockchain. Making sure that's trustable is a problem. If you're talking about like funds, obviously you have NAV calculations that don't necessarily always happen that regularly as well. So what is the actual I guess like continued time of when you'd actually even like update the pricing is still a question that people need to understand, and I don't really think we have an answer to that just yet. And then there's other things that just like, what is the actual price of something? I mean, if you talk like watches as an example, that technically there's a market clearing price, but it's a very opaque thing by nature. So it's also a little bit in the eyes of the beholder. Like, what do you actually want to pay for this kind of stuff? Maybe I'll pay this much for an AP, but you don't. So all these things are challenges that make real world assets honestly one of the hardest problems in crypto to solve. And just creating some kind of like existing legal framework or wrapper to bring things on chain is not really the end solution. I think we're all of us are probably trying to create new novel structures. I think Ondo's done a great job with their USDY product and OUSG product to actually bring these things on chain. I'm not even going to show you too much, but bankruptcy remote and like we're a partner, so we got to show a little bit. But so there are different novel structures that are being created. We're doing stuff with real estate where we're legitimately tokenizing the title deed itself rather than like an SPV that owns the equity in something. That's basically just like a tokenized REIT, which is kind of bullshit. Like we need to push towards what I consider not to be faux tokenization, but actually real tokenization of things. But that is the challenge. That's the hard part. And pricing is one of those considerations that is hard.
Yeah. At Ondo, we make when you think about tokenization, there's a lot of companies focusing on real estate and some other types of assets. I wish them always lots of luck because it's an incredibly hard product and hard thing to do, in part because of this pricing issue, right? At Ondo, we make the decision to focus only on the stuff that has deep liquidity already in traditional financial markets, right? Think of your stocks and ETFs with our global markets platform, tokenized treasuries, because then in part, at least you can sidestep some of the issues that you have on the pricing side of things. But to your point, even then, traditional markets don't operate 24/7. So what do you do with the price when traditional market is closed, but crypto markets are not? Like that, those are workarounds. On top of that, there's just some things that you wouldn't necessarily consider when you start tokenizing stocks. There's stuff like corporate actions, like a stock split and dividend payouts. How do you reflect those in the price of the tokenized asset? Most would say, well, just pay those dividends out to the holder via stable coins or whatever. That's fine. Yeah, you could do that, but a smart contract can't actually deal with it that way. So to account for that, you can wrap your assets and have the price just go up depending on when dividends get paid out, in addition to when the market moves. But then you're in a situation where an on-chain asset has a fundamentally different price than the traditional asset because you wrapped it because you need to account for dividends and the like. And then people look at that and they're like, why is that different? And so there's just all sorts of these mechanics that because you're on chain and you are programmable, interoperable 24/7, you can engage with smart contracts. It's an incredibly powerful technology, but it really does create some operational challenges, particularly related to pricing, and there's no easy way around that.
Yeah, I mean, I would echo what the other guys here said. I mean, kind of like JPM mentioned too, I feel like it does kind of differ, like, on an asset by asset class basis. And I think valuations, like the valuation methodologies, they are, they're still done off chain. So whether it's like, you're using public comps, you're doing appraisals, depending on the asset class. And I think once that valuation is set, bringing it on chain through these different Oracle providers and data providers is what's the most important piece. But like everyone here mentioned, it is kind of an issue right now to price these assets 24/7, because I would say like there are more public liquid assets that Ondo folks you guys are working with, but like we're also seeing like more esoteric assets. So like the question is like how do you really price these assets that don't really have a 24/7 market? And in traditional markets, when let's say the price of the on-chain asset is higher than the off-chain asset, then market force can come and arb the prices back to NAV, back to par basically. But from what we're seeing is for the more alternative type assets that we're dealing with, like we need to find different data structures and basically different ways to bring this data on chain in a secure and great manner that makes sense. And that's what we're trying to solve as well at Plume. We're building different data, I would say like sort of like data oracle channels to bring in different types of data from these different types of assets. And that's definitely something that we have on our roadmap as well, because I think pricing these assets, whether on chain or off chain, is very important, especially if people are treating them on chain. But yeah, that's what I would say to this.
It also raises the question, like, why are we tokenizing these assets, right? You mentioned watches and whiskey and like all of these esoteric assets. Like, why do they need to be priced in real time? What is the actual function of pricing that in real time? Can't we just see all of the history of all of the trades that have existed for those assets and be basing it off that? And so there's this is where it is asset class by asset class. And I think there's a bit of a misnomer. You tokenize things and then all of a sudden these secondary liquidity markets are just going to appear. You tokenize a property, it doesn't mean that property is going to start to trade every day. Right. And so I think that there's this, we'd have to get past this secondary liquidity as the be all and end all. I think it will exist fantastically for some assets and really be an unlock. But there has to be utility beyond that for why we're tokenizing these assets.
I have maybe a comment, and then I would actually like to see if the other panelists think the same way. So I kind of think that we're in this three-phased approach for real-world assets, which phase one is really supply side, so bringing on high-quality products and assets. There's no limit to the amount of shitty assets people want to bring on chain, and to your point, like that doesn't necessarily mean that they're going to be better because they're in tokenized form. In many cases, they're actually probably worse because you're actually taking it away from a lot of people to be able to buy it. So that's phase one. Phase two is solving secondary market liquidity issues. How do these things trade? Are there venues for them to even be distributed on? Who's buying this? To your point, like, can my friends buy it? Can my grandma buy it? Can my parents buy it? Like, how do we actually get in the hands of people? Particularly if it's on chain, that's still a very small population relative to the entire globe or opportunity set. And then phase three is this kind of like composability. So how do you use them within DeFi? How do you use them as margin? How do you use them cross chain? That's kind of the way that I'm thinking about it. I don't know if you guys would resonate with those three phases, or if you think there's more or less, or.
Yeah, I would say, I think the composability piece is pretty key for like the more esoteric assets, because you're able to finance these different types of assets like on chain, where like, in the traditional world, they don't have markets. And, that's why, at Plume, what we're building is really a network and an ecosystem where we have a bunch of different types of RWA projects with different assets, and we have a bunch of DeFi primitives on the other side. And that way we can try to create these different markets that, basically enables trading of these once pretty liquid assets that are, typically off chain. And, I think that is where the space will potentially, trend towards in the future for sure. Yeah.
Yeah, I'm not sure I'm with you on the liquidity piece, like step two.
In what sense?
I'm just not sure you're going to find it for some type of assets, because fundamentally in certain assets, there's just an information asymmetry that tokenization doesn't solve. So if people can't get comfortable around the price of an asset and how to underwrite it, they're never going to buy it. It doesn't matter how much liquidity you try to pump into the ecosystem.
What asset would you suggest? Like, what's an example? Just so I can think about that. I'm really curious. This is
a lot.
Sorry for hijacking this, but
honestly, a lot of them. Anything that's not publicly traded and doesn't have the appropriate and associated disclosures with it, I would personally find very hard to underwrite. And I would include a lot of real estate stuff and whiskey and watches and all those sorts of things in there. it's not, doesn't mean it's impossible, but it's a challenge, right? When I think about tokenization and how it took off, I mean, the panel before us was stable coins. Stable coins just tokenized cash, right? Like, and that grew like a weed. Why did it grow like a weed? Because for a long time, it was the only way that you can on-ramp them to crypto exchanges. So you facilitated platform-to-platform distribution. And then the second big unlock turned out, hey, let's make this cash program. Like, first step was make it global. Second, move 24/7. Second step is give it programmability and utility in DeFi, right? Just look at what happened to the USDC market cap between like November 2020 and then a year later. November 2020, USDC was at 500 million or something, right? And then it grew to 40 billion. Well, all of a sudden, DeFi got unlocked and people found new sources of yield, and that was really cool, right? So when I think about how is tokenization going to take off for other types of assets too, it's global access and give it new sources of yield by making it programmable into smart contracts. You could do that, as an example, with securities, like stocks, like equities, ETFs, all these sorts of things, right? Sec lending is a giant revenue pool in traditional finance that has not been disrupted yet because equities have not been put successfully on chain. But so there's just a wide variety of other asset classes that maybe don't have the same pricing issues, that don't have the liquidity issue, that probably makes sense to tokenize first. Does that mean that real estate and the like will never get tokenized? No, but I just don't think they're going to be the next thing to take off.
Exactly. Because the problem is that there's no capital in the system, right? I mean, we're all here and we're doing our best, but let's look at even tokenized treasuries, right? There's 2 billion in the context of treasuries. It's absolutely nothing, and no large asset manager is going, well, let me go get my treasuries on chain. So there has to be new financial primitives, new utility, actual reasons for them to bring capital on chain to access new product before they're going to do it. They don't just do it because, oh, well, tokenization sounds great and I want to support this initiative. These guys do it to make money. And so we're so far away from having meaningful amounts of capital exist on chain to be even worrying about liquidity or any of these other things. And so there has to be, yield in DeFi was a reason that a heap of capital came on chain. What are going to be these other utilities that are going to bring large amounts of capital on chain?
So are there any like new utilities that consumers can expect, or is it more about like bringing more liquidity on chain? I just want to navigate this conversation to next step. I want to ask like which kind of actual problems or any other steps that you guys are looking for answering all of those like questions.
I'm happy to go first. So like the question is a little bit like what's next, what to expect, how does this get unlocked? When I think of the problems of tokenization today, I'd say there's 3 big ones. Number one is there's just not enough assets on chain, right? You've got some cash, you've got a little bit of treasuries, that's it, right?
Not enough real estate.
Not enough
We're
real
working
estate, but like there's almost nothing there. And so you got to put more assets on chain so that you can tap into new types of use cases, right? But in order to do that, it's problem number 2, is there's not really a DeFi ecosystem that was built with securities in mind, right? Crypto, like DeFi, works with digital native assets. It works with stable coins because they don't, they're pretty basic, they're very simple. But the moment you go beyond that with stuff that has dividends, corporate actions, yield that accrues on a token, that's problematic, right? Because DeFi is not built to work with these types of assets. So you need a new type of ecosystem that is purpose-built to also work with securities. It's possible, but no one's really built it yet. And then number 3, I'd say, is just making distribution easier and omni-chain infrastructure so that people don't really have to worry about how do I take my asset from ETH to Solana, and that asset issuers also don't need to worry about which chain do they actually issue on, but it all becomes one big omni-chain interoperable ecosystem so that distribution can take care of itself. But I'd say those are the 3 things to take a look at: more assets on chain, actual utility for these assets, and then easy distribution via omni-chain infrastructure.
I agree with everything Ian just said, other than the real estate part, but it's okay. We're working on it. I think one of the bigger challenges, more from a retail perspective, is actually just the educational piece. Like, particularly the current market of users is really crypto native people who are doing stuff on chain. And completely honestly, like the crypto native experience is pretty shitty. So expecting like people who are, buying this stuff maybe in their real life, why would they do it on chain? It's just added layers of risk and uncertainty. So we need to work on improving that user experience significantly. And that's part of like, I think a lot of people are working on key abstraction, chain extraction, like all these different types of technologies, which make it a lot better for the end user to actually participate in an on-chain economy. That's one step that we all need to work on as an industry. And I think the other part is like, again, why do we even need to do these things on chain in the first place? Like, you can tokenize basically anything, but it doesn't necessarily mean there's added value to the end user or to the end or the original issuer, right? So having that in mind from day one is quite important. And then, I think what we're seeing with a lot of the products that we're bringing on chain is just like making sure that they're all kind of home runs in the beginning. So finding something that would already be sellable or like investable in the real world. Because if it's not investable in the real world, then don't bring it on chain because it's not going to do anything there either. And we're kind of seeing this makeup of like, maybe all these deals that we're placing, probably somewhere between 10 to 20% of the actual participation is retail, and the rest of it is still institutional. Even with like, we have a USDY pool with Ondo, and probably about, I think roughly 20% of it is retail, and the rest of it was all institutional money. And I think you're going to see that over time. We're going to launch all these different vault products effectively. And again, it'll be like, we're only going to do 1 million, 2 million, 3 million, 5 million kind of vaults for the retail side. And the rest is like, all insta money. So I think from a retail perspective, we're like the product market fit is just not there yet. Particularly because the people who are doing it today, they do want speculation. They do want, meme coins. They do want this type of stuff that is not necessarily exactly RWA. And I think in a bit more of a bull market cycle, which I don't even know if we're really in a bull market right now, it's a little crab market. They're not necessarily like, oh, let me park this all in, yield bearing like RWA products right now. They're still looking for the moonshot. So I think there's a lot of education that needs to happen.
Yeah, I think the education piece I definitely agree with. I think the one piece that I somewhat disagree with is I think I think sequencing is pretty important, and I think that right now a lot of the on-chain audience, I think they're more like crypto degens, to be quite honest.
I agree.
I think it's probably like 80-20 crypto degens to TradFi, or like 90-10, and I think because of the audience that's on chain, you need to give them use cases that they would really understand. So basically more like crypto native action. So like, how do you borrow, lend? How do you trade? Yield is always a first class citizen. So obviously people are trying to park assets or park their money into these different yield bearing assets. But, at least at Plume, what we're seeing is, and like we saw it on our testnet, like we had a bunch of different products join us week after week. And we saw that the more speculative use cases had more usage, honestly. Like we have a protocol building on us that, lets you kind of take a long short on different social sentiments and kind of lets you like trade and like bet on different directions of like different market assets. And this protocol honestly had way more usage than the other ones. And I think it's very interesting what we're seeing now. I think, because we're working with over hundreds of different projects. And I think there's been a shift of people tokenizing assets in the real world and bringing it on chain to more so like people tokenizing data and bringing it on chain and then creating almost like a GMX type model where people, they can take on leverage and trade these different assets. And they're really just trading the data component of it. But because of this, it's a little bit more scalable. You can go around some of the compliance and regulatory issues, and you can really create markets out of nothing. And I think that is where, the future could be going, especially with the intersection of DeFi and RWA. And that's what we like to call RWA-fi at Plume, because honestly, it's pretty interesting. And I think, that is basically where a lot of the volume, and I think initial user traction will be. And then of course, like as we progress, obviously I think institutions, that's like the end game. But at least for us, we want to sequence everything to, initially build a brand and to, approach the market in the right manner.
Yeah, I mean, to reiterate from before, I think like the major thing is we just need more capital. Seraphim said it in the panel before. There's maybe 50. He said 50. I'd say there's maybe 100 people that control all of the capital flow in DeFi, and so it's very concentrated capital that exists today. And there's two major ways to bring capital on chain. One is through retail, and the other is through institutions. And I think that potentially the retail angle is going to be unlocked sooner because you've got a bunch of regulatory hurdles and a number of other issues for large institutions to bring capital on chain. Whereas on the retail side, the major gap is user experience. And so I think that's where there is the potential that some of these big fintechs come in and some of the bringing the Web 2 user experience to Web 3 use cases can be the big unlock for retail to bring their capital on chain. But yeah, I think that is more likely to happen sooner than any large amounts of insto capital coming.
I have one comment on that. I think that's highly jurisdictionally specific. So we're seeing, particularly in the Middle East and Asia, that's not the case. Middle East particularly, it's heavily institutional money. But you also have a very supportive, progressive regime that's allowing this to happen at the sovereign level. Literally sovereign level.
Maybe I need to move to Dubai
exactly.
then.
We know they're playing. Trust me.
Yeah, actually, I did not ask that much, but all the conversation was very interesting. I totally agree with the point that in like users' perspective, education is very important, and also the asset should be viable, like in real world. So it actually brings the utility on chain. I really want to cover more questions, but my time is already ended. So let's wrap up. And I just want to hear the like last word about like what you guys are focusing these days, and like just anything you want to highlight for this panel.
Mainnet next month. Let's fucking go.
No, main thing I would say is that I think these guys are doing a great job, and there are a lot of great companies out there that are tokenizing assets. And we've decided not to get too involved in that, and we want to be the institutional lender. And so we'll let all of these guys do fantastic work to bring these assets on chain, and then we'll be sitting there to create real utility. So we can take these assets as collateral, create institutional lending markets and real utility throughout the crypto ecosystem.
Yeah, I didn't mention it that much, but we have two products. One's called OUSG, one's called USDY. We got a lot of cool new innovations, I say, coming in the next couple of months. New chains, new integrations, new protocols. We're at 620 million right now in AUM combined. If I'd have my way, that would be $1 billion by, end of this year, early next. That'd be pretty great.
Nice. Yeah, I mean, for us, mainnet is sometime in Q4, and I think our biggest focus right now is building the ecosystem up, getting more protocols on board, working more asset issuers to tokenize their assets through our pipeline, and also securing these different capital partnerships we have both off chain and on chain. So there's a lot going on, and our testnet is we're launching a second version of it after Token. So yeah, there's a lot to check out. So if you guys haven't checked us out before, definitely give our website a visit.
I got to go to another panel with Ondo and Plume. So I got to run, but thank you guys.
Yeah, thank you for
Thanks, guys.
listening. Thank you for attending. Thank you.